Okay, we're going to go ahead and get started and be respectful of everyone's time. Welcome today to the SSBCI webinar for lenders, co-hosted by the California Pollution Control Financing Authority, also known as CPCFA, and California Infrastructure and Economic Development Bank, also known as IBank. We wanted to just start with a few housekeeping items. My name is Karen Ngayan. I am the Deputy Director of External Affairs for IBank. And we just want to remind everybody that this webinar is being recorded. And after the webinar, everybody who registered will get a copy of the webinar itself, the webinar recording, as well as fact sheets for each of the programs that you'll hear about today. And all of the materials that we shared during the webinar. So everybody has been admitted with their cameras off and muted, and we ask that anybody who is not presenting, please remain on mute during the presentations. We do want to remind folks also that this webinar, if you are a small business owner, that this webinar is actually not designed for small businesses. However, at the end of the webinar, when we do send out all the materials, we will include links for small businesses to access resources through the California Office of the Small Business Advocate. And so with that, I believe we are ready to get started. And our first speaker is going to be California State Treasurer Fiona Ma. And I will go ahead and turn it over to the treasurer.
Thank you, Karen. Can you all see me and hear me?
Yeah.
Yes.
Okay, thank you. So thank you all so much. I'm very, very excited to be with my IBank partners and Cal, our Cal CPCFA group in administering this SSBCI 2.0 program. Some of you have been our participating lenders over the many years, and we really appreciate you being part of our network. We are hoping with this extra $1 billion that's coming that we will get more lenders. And I thank everybody, all the stakeholders who have been working with my office and IBank so that we can make sure this program is rolled out as efficiently, as effectively, and as quickly as possible, because we know so many small businesses and individuals are still struggling post-COVID. They did not get a lot of support, during the COVID Federal Rescue Act money. And it is even more important now as I am out there in the community working with small business owners. They're always asking for access to capital. Where can we get a small business loan or a line of credit temporarily? And so we are very excited that we are able to be here and to partner with IBank on this very important program. Scott Wu, I know, is going to be speaking, as well as Sheila Tobias Daniel. And so I'm going to leave the nitty-gritty details to them. But again, thank you so much, participating lenders, for participating with us again. And we look forward to our continuing working relationship and partnership with all of you. So I'm going to turn it back over to Karen. Thank you all.
Thank you.
Thank you, Treasurer. And now we will go ahead and turn it over to Scott Wu, who is the Executive Director of IBank.
Thank you, Karen. Thank you, Karen. So I'd like to begin by echoing the Treasurer's appreciation, especially for those of you that are already using our small business programs. Together, you and the state's nonprofit financial development corporations, which you'll also hear from today, are the ones who make it possible for these programs to reach their potential, helping you grow your portfolios while also serving the vital small business community. For those not familiar with IBank, we're part of the Governor's Office of Business and Economic Development and serve as the state's general purpose finance authority. In addition to economic development and improving the quality of life for Californians, our current priorities are creating jobs, expanding access for the underserved, and supporting climate change solutions. Our small business loan guarantee program has been operating since 1968, but never at the scale that we envision going forward. It is led by our fantastic Small Business Finance Center manager, Megan Hodap, who you'll also hear from later. California had impressive outcomes from the first round of SSBCI instituted in 2011, which we call 1.0. With 1.0, we received 168 million, split evenly between IBank and the State Treasurer's Office, to operate 3 of the 4 small business programs that we are now operating, with the 1.2 billion we're receiving from 2.0. With 1.0, we supported more than 10,000 small business loans that generated more than $1 billion in total financings and created or retained nearly 100,000 jobs. Compared to other states, that accounted for nearly half of the SSBCI loans nationwide, nearly 40% of the total jobs, with the highest percentage in the nation of loans to women or minority-owned businesses at 62%. And more than half of those loans across the entire programs were in low to moderate income areas. For SSBCI 2.0, our outreach strategy is critical for reaching underserved communities. As a government agency, we don't have a marketing budget. We have to work through a network of partners that are known and trusted in their communities. This includes our financial development corporation partners, the small business development centers, community-based organizations, small business advocacy groups, and of course, community lenders like yourselves. A major focus and a US Treasury requirement in 2.0 is also reaching and increasing our reach to socially and economically disadvantaged individuals. $100 million is at stake for the state as an incentive. To accomplish this, we need to increase lender participation in SSBCI programs, including with more CDFIs and MDIs. And lastly, I wanted to briefly mention that IBank just launched a few weeks ago a new $200 million venture capital program. California, the global headquarters of venture capital, has a unique opportunity to catalyze a more inclusive venture capital ecosystem. This new program is focused on overcoming market gaps in the industry by increasing the diversity of investment managers and startup founders, by providing capital to underserved regions of the state and to businesses focused on climate equity. More information is available on IBank's website. And so I'll just close by saying thank you again for joining us here today. IBank, along with our fabulous partners in the State Treasurer's Office, look forward to an opportunity to work with you and to support you. And with that, I'll turn it back to Karen.
Thank you, Scott. And our next speaker will be Sheila Tobias Daniel from CPCFA, who is the Executive Director. Sheila.
Thank you, Karen. Good morning. Thank you all for joining us today to discuss the State Small Business Credit Initiative, or SSBCI 2.0. As you all know, the funds are coming to us, to Team California. That's what I like to call our partnership with IBank. That money is coming to us in 3 tranches to be expended over 10 years. And as my partner, Scott Wu, and my colleague, Scott Wu, just laid out for you, the amount is almost 1.2 billion. This is a significant amount of money. I believe we received the largest allocation of any states. And as you know, that puts us in the spotlight. All eyes are on California. This amount is much more than the original SSBCI. I think the first one for 1.0 was that allocation was 168 million for all of California. And to put it into perspective, each of us, IBank and the Treasurer's Office, our half of the first tranche is over 178 million. And that is more than the entire allocation for 1.0. So we have a lot of work to do here in California. And, we learned a lot from SSBCI 1.0. One thing that we learned, and I want to echo the treasurer and Scott in saying that our lender network and our participating financial institutions, they are key. You guys, we learned that robust lender participation is the key to making these programs effective and successful. So the goal this time around is to increase lender participation in all of our programs. And with our participating financial institutions, California can complete the first tranche in order to receive the second tranche. I don't know how many of you know this, but we have to expend just about 80% of the first allocation for the first tranche before we can even be eligible to receive the second tranche. So if we want to keep the funds flowing and the allocation coming in, we've got to get the money expended through our lender networks. So I just want to echo again, everyone, in thanking you for participating in this webinar today. Hopefully there's a lot of information that you will gather that will help you be solid in your decision to continue participating in our program. And those of you who are not already participating in our programs, we're hoping that you'll be encouraged to do so. So with that, I am going to turn it back over to Karen for your next speaker.
Thank you very much, Sheila. Our next speaker is Megan Hodap, who is the manager of IBank's Small Business Finance Center, and she's going to describe, give a high-level overview of the programs themselves. And Megan.
Good morning, everyone. As Karen said, my name is Megan Hodap. I am the manager of the Small Business Finance Center here at IBank. So with SSBCI 2.0, as we're calling it, there are three main programs that we already had established in California. So I'm just going to kind of go over each of them at a high level so you can kind of get an understanding for them. I know many of the lenders on the call today use one of the programs, a couple of the programs, but we want to give you guys an understanding about each of them and how you can use them together. So I'm going to start on the left-hand side of this chart with IBank. So the Small Business Loan Guarantee Program incentivizes lenders to make loans to small businesses by offering guarantees up to 80% of eligible loan amounts with a $5 million maximum guarantee amount. The program can support loans up to $20 million, and our maximum guarantee term is 7 years. The loans can be used for a variety of purposes, including startup costs, construction, inventory, working capital, and more. If a borrower defaults on one of the loans that are guaranteed, the lender then liquidates available collateral and submits a request for a payment on the guaranteed percentage of the outstanding principal on the loan. The Small Business Loan Guarantee Program is facilitated by our 7 financial development corporations, who in turn work with our list of participating lenders to underwrite the loan and get the guarantee in place on that loan. And then next up is CalCap for Small Business at CPCFA. For this program, a small business applies to a participating lender for a loan. The lender applies its underwriting standards, then the lender determines the enrolled loan amount and the contribution percentage between 2 and 3.5%. The small business and the participating lender each contribute the selected percentage of the enrolled loan amount to the lender's CalCap loan loss reserve account. Within 15 days of loan issuance, the participating lender submits an enrollment application to CalCap. CalCap then matches the lender's contribution to the loan loss reserve account and contributes to the severely affected community portion, if applicable. The participating lender is eligible for up to 100% reimbursement for certain defaults, and that reimbursement is made from the participating financial institution's loan loss reserve account. Next up is CalCap collateral support. For this program, a small business applies to a participating lender for a loan. The lender applies its underwriting standards and determines that the proposed loan is under collateralized. The participating lender then submits a collateral support request and a small business risk assessment to CalCap prior to loan issuance. CalCap evaluates these two documents. If approved, the small business and the participating lender must finalize the loan within 90 days. The lender submits final loan information and closing fees to CalCap within 15 days. CalCap funds the cash pledge with a deposit to an account unique to that specific loan. The cash pledge is then available to the participating institution in the event of certain default conditions. So like we said, these programs are like, the analogy that we're using here is that the programs are like vehicles. Vehicles are all designed to get you from point A to point B. These programs are all designed to make it easier for small businesses to access capital while helping you as a lender grow your portfolio and reduce your risk. Vehicles all have certain things in common, but the specific vehicle you pick depends on a lot of different factors, including purpose and preferences. Likewise, SSBCI programs have certain things in common, but the one you select to use in any given situation to serve a customer will depend on a variety of factors, including purpose and preferences. In the way pickup trucks aren't competing with sedans, these programs aren't competing with one another. The one you choose will come down to the borrower's needs and your needs and preferences as a lender. Later on in the webinar, we will even hear from a lender who has utilized multiple programs concurrently to serve the same customer, as well as a few lenders who use each of the programs. And with that, I am going to turn it back over to Karen.
Great, thank you, Megan. So now we're going to dive into essentially what is the meat of this webinar, and that is hearing directly from California's financial development corporations and lenders who are already using these programs. And we are going to start with Sanford Livingston, who's president and CEO of the NorCal FDC, also known as the Northern California Small Business Financial Development Corporation. Sanford.
Thank you so much, Karen. Woo woo. We are so glad to be on this call with the IBank as well as the Treasury office, and this is great news. We very quickly, we're just going to let you know we're one of the 7 FDCs, financial development corps in California, serving the needs of our lenders by operating and offering the state guarantee program as one of the deliverables for our. Just to give you a quick background, as the executive stated earlier, the program has been around since '68, but NorCal has been around since 1978 to provide the guarantee where the traditional means of providing capital is a little tough, and we need some additional synthetic collateral to credit enhance the deals that many of you out there are working on. And if you just have that extra push of synthetic collateral or backup for the deals, as we say, and Megan has taught us, we don't make bad deals good, we make good deals better. And so that's what we've done overall. And so I have this quick slide just so you'll go through and you'll get a sample of how the FDCs, we do it differently, but all of us do quite the same deliverable. And I want you to have a sample of how we actually present this information to you. So next slide. Very quickly, the guarantee program, the purposes, as for all the purposes that small businesses need for the inventory, working capital, lines of credit, to refinance existing business debt and those kinds of things, we offer the lenders the support for that. So oftentimes as they go through proposing and approving their particular deal, they approve it subject to guarantee, and then we go into what we do in providing that particular tool. That's for term loans, sometimes line of credit to term to actually converting to term, and then the lines of credit. And we offer 80% of the guarantee up to now 5 million. Used to be 2.5, it is now 5. And as Megan described, it talks about the maximums, and we have that listed on the slide for you as well. Next slide. Next slide, Megan. Yeah, thank you. And the benefits, we oftentimes when we're talking about this incredible program, and I've worked at larger banks for about 20 years, and I hadn't heard about it. As Scott said, there's no marketing dollars for, actually spreading the word. So we do it word of mouth by doing programs like this and webinars like this to let folks know that this is a very, very wonderful tool to help us disseminate capital to even other lenders that don't, other borrowers that don't fit the traditional lending model. If there's a new business, entrepreneurs that have minimal collateral or even have a short credit history, this is a great tool to use. And just to let you know, often the question is asked, well, what's your performance? Well, for the whole program, the performance is less than 2% default. It's really an easy program to use. What we do is we, provide an application to certify the lenders, and that's provided by IBank, and we get that. It's a very easy turnaround. It's meant just to make sure that all of the users of the program, all the lenders are stable and they meet the qualifications of the state. Another thing that happens is, you got to realize the cost. You say, well, I don't know if I could use this program because of the cost. Well, the cost is a one-time fee of 2.5% of the guaranteed amount up to 2.5 million, and over that amount, it even gets less. It's 2.25, and that fee is often picked up by the borrower. So the borrower is picking up the fee. The lender is getting a great credit enhancement added to its particular deals and protection of its capital. And as a group, as a collective, as a Justice League, fighting off the various issues of inflation and the other things that have plagued us lately in California with fires and pandemics, we provide this protection that allows us to keep creating jobs in the 5th largest economy in the world. Next slide. And so I wanted to just briefly give you, so that when this call is over, you have the ability to look at the various differences between the SBA and the state, the Small Business Loan Guarantee Program. We're actually, people think we're competitors. We're not really. We're actually very complementary with some of the lenders that we're working with of the SBA. So if something doesn't fit the SBA model, say for instance, we have, I would say, nonprofits, so to speak. Nonprofits don't fit the SBA model, but they do fit the Small Business Loan Guarantee, just for an example. And I put some other information there for you as well, and we don't have time to go over all of that, but I just wanted to make sure it was available to you. Next slide, Megan. And so just to let you know, IBank is just incredible in terms of providing us with tools when we're supporting you, the lender. We have one that's off to the side, which is $10,000 or less, our Jumpstart program that helps really small businesses get their footing. And then you have the disaster relief, fires, floods, issues, pandemics, those types of things that happen to California. And the IBank has, really offered help and support to the community by even going upwards to 95% guarantees in certain instances where it's applicable. And I just wanted you to have that information as well. Next slide. Great. So this is the slide that I wanted to make sure everyone knew. And there's another gentleman who's going to follow up after me, but we have 7 FDCs across the state. None of us are bound by any type of geographical issues, because we all can do deals all over California. The only boundary is that all the deals have to be done in California, and that's, so be it. So we're good. And just to let you know, some of the deals that we've done, we had a vegan company, African-American owned vegan barbecue company in Oakland that just didn't have enough collateral And through one of our CDFIs, we were able to use the guarantee to provide the funds needed for that company to grow and prosper, and it's doing just that. We had another charter school where, many of the students that were there didn't have housing. And we had all of the various folks working on this particular deal, and it worked out just well. It was in San Francisco. And where that synthetic collateral is needed for policy and regulatory issues with banks and lenders, we provide that gap and we fill it very nicely. And we, like I said, we don't make bad deals good, we make good deals better. And we've been able to do that in an area where traditional lending just has a difficult time operating. So we have that. Those are two of the many deals that we've been able to help entrepreneurs with in creating jobs. And just so that you know, there was, I was asked to talk about when, we have a difficult time with a deal. Well, we have a difficult time. Sometimes we have, like I said, we have like in NorCal, maybe dealing with 30 or 40 of the 120 lenders that are working with the state guarantee. But sometimes we have a difficult time when there's a lender that is looking at projections for a particular company, and the projections aren't necessarily confirmed or we don't have enough information about, the growth or contracts or things that back up what the supposed projections are going to be. So there are certain issues that we have, but we work with the underwriting for the lender. We work with your package where there's no application, and we do a great job in trying to make sure we can grab more of you to be certified to use the new SSBCI money, as well as the other tools that IBank has, as well as the Treasury's office with CalCap. And thank you.
Thank you, Sanford. So we are starting to see just a couple of questions in the chat. I just want to remind everyone, please go ahead and put your questions in there. We will get to those at the end. And I also just wanted to remind everybody that you will receive a copy of this slide deck and the recording of the webinar, as well as fact sheets and any other documents that you see during the webinar. So we will email that to everybody after the webinar wraps. And so with that, we will go ahead and move to our next speaker. We have Juan Carlos Hernandez, President and CEO of the Southern California Small Business Development Corporation. Juan Carlos.
Thank you so much, Karen. Good morning, everyone. My name is Juan Carlos Hernandez. I'm basically based out of San Diego, with part of the Small Business Development Centers, part of the IBank, the Small Business Loan Guarantee Program. I wanted to just kind of a little bit double up with what Sanford is mentioning. There are 7 of us throughout the state. We all basically really work closely with our lenders to facilitate the access to capital for all of our markets. We are not restricted by being in a particular territory, so we do serve the entire state of California. I didn't want to go through pretty much the same information that Sanford mentioned, since we pretty much do a lot of the same information or a lot of the same services. However, a couple of things that I wanted to just really establish is with us here in San Diego, in Cal Southern, we focus primarily on the small businesses, the folks that really need that, up to about $200,000 in either working capital to purchase equipment, inventory, other operating costs. So we're not here to compete with either SBA or with CalCap's program. I think, as Sanford mentioned, we can actually work jointly to better serve the clients or the borrowers that need both programs. We work a lot with the CDFIs, as well as banks, other credit unions, and in some instances, we actually have had a couple of private lenders that meet the criteria in order to be part of the Small Business Loan Guarantee Program. Just on a couple of different things, again, we want to be able to be a second or a third resource to the lenders so that they can provide those services to folks that may not necessarily meet an SBA criteria, but they can actually either use us instead or in conjunction. A couple of the programs that we work with is there is one particular lender that I work with that has been very successful at establishing the 504 program for the acquisition of a commercial real estate for small businesses. However, they've actually used our particular program to finance some of the tenant improvements once they do move into the new location, so that they can have that working capital to continue their business, their day-to-day operations without any kind of disturbance. The other aspect is, again, we can actually use, or we have another lender who works on doing more equipment financing. But then there's other costs for working capital to provide once that equipment gets delivered to their location, to be able to then ramp up their operations. So they do need a little bit more of working capital for inventory, raw materials, and operating costs to hire additional other employees in order to accommodate the increase in their productivity. Our goal really is to work side by side with the SBA as well as the Office of the Treasurer in order to provide this particular type of cooperation, to be able to provide that working capital as well as, but for it to be affordable capital for the borrowers. As Sanford said, we are very competitive when it comes to the fees that we receive. But again, it's more along the lines of we tend to work very close together, even within our own FDC families, to find out which one of us is a little bit closer, that can be a little bit more convenient for the lenders to participate in, that know the area. One of our expertise down in San Diego, I'm not familiar with agriculture. So when I do have a lender that is looking for an agricultural loan, I would tend to refer them to one of my sister FDCs that is much more familiar with that particular industry, that can provide a much better service for it, and work with that particular lender to provide the guarantee necessary in order to have the borrower receive the money for their company. Again, it's one of those scenarios where we're not here to try to replace or take advantage of replacing the SBA product or CalCap. We actually want to work with them and to be able to address those other needs. Sanford mentioned the possibility of helping nonprofit businesses in order to receive working capital. But then there's other types of programs that we use. We also, through one of the things that we do is we have foreign investors that open businesses here in California where they would not be eligible through an SBA program. However, we would be able to facilitate that guarantee for the banks to finance these folks that have a foreign status or they have an investor visa coming into California to, again, continue to build our infrastructure. The other opportunities is for the employee stock ownership programs. We have employee-owned companies that do not qualify for an SBA guarantee, but they will qualify to be able to use our program to continue to grow their business. So there's a couple of things that we can do to assist, and at the same time, there's other things that it makes sense to just go through either SBA or through CalCap in order to move forward. But then again, we do have some lenders that have been able to figure out how to use either 2 of the programs or even 3 of the programs simultaneously so that they can provide that service to their borrower. That will in turn allow for the increase and the retention and creation of jobs here in the state of California, which is literally what our goal is to always make sure that we provide that type of capital and the service and basically, for lack of better terms, the client service for our borrowers, and then of course to our lenders to make sure that they have the sufficient resources to be able to go out and lend that particular money and reduce the risk for themselves. With that, I'm always open for any kind of questions. Anybody wants to come out to sunny San Diego, Just want to show off a little bit of what we have. We actually we just hosted the Farmers Open last weekend. So there's no place like San Diego to come and enjoy the sun. So thank you, everyone. Thanks, Karen, for having me.
Thank you, Juan Carlos. And now we're going to start hearing from some of our lenders who are using the programs. And we're going to turn it over to Luz Arrutia from Acción Opportunity Fund Community Development. Luz.
Thank you so much, and good morning, everybody. Thank you first to Treasurer Ma and Scott at IBank for hosting this event. And thank you to the IBank and CPCFA staff for inviting us to join this panel. I'm here to share a couple of our experiences with two of California's small business programs, the CPCFA CalCap, or the California Capital Access Program, and the State Guarantee Program at IBank. A little bit of background: Acción Opportunity Fund is a nonprofit CDFI started in 1994 in the Bay Area. And our first loan was $500 to Rosa. She's a florist in Redwood City, who to this day credits that loan for being in business and doing pretty well. Since our inception, we've expanded throughout the state, primarily due to these two very strong small business programs that we'll discuss today. And we've also expanded our lending into 44 other states across the country. Our focus really is on creating an inclusive financial system that provides small businesses that have been left behind by the mainstream financial system with affordable loans, coaching, business advising, and support networks that they need to thrive and to succeed. To date, we've deployed more than 25,000 loans, totaling approximately $775 million. And the vast majority of those loans have gone to small businesses in California. In the last year, we lent almost $80 million in California alone using both IBank and the CPCFA, the CalCap program. So I'm going to start with CalCap from CPCFA. You know, frankly, I'll tell you that these numbers would have never been possible without the state's program. You know, as a nonprofit lender, we leverage this program to access private sector capital for lending and philanthropic support. And as our customers pay us back, then we recycle those funds to make more loans to under-resourced small business owners. I have to say that CalCap has been a major catalyst for our growth. The program has given us the backstop that we needed to attract that private sector capital from banks, to lend to thousands more underserved small business owners in California. Entrepreneurs, these are business owners who are usually considered much riskier customers due to their thin credit profiles, lack of collateral, not having traditional documentation, not having enough time in business, or their businesses just being too small for mainstream financial institutions. And unfortunately, as lenders, we know that women, people of color, and immigrants fall into these groups more often than not. We've enrolled over 15,500 loans into CalCap since we began using it in the mid-2000s, both in the Small Business Loan Loss Reserve Program and the Air Resource Board, which is known as ARB for our trucking loans. And these loans are over, close to $500 million, or more over actually $500 million in total. And between these two programs, 89% of our enrolled customers identified themselves as people of color, almost 1/3 identified as women. And the majority of these small businesses have been low to moderate income. I always say that CalCap has been very elegantly constructed program because it has helped us serve many entrepreneurs across the state without sacrificing much in convenience or speed. The loan enrollment process at CalCap is quick. In the front end, your customer signs a one-page form at the closing of the loan. The fee to enroll in the program is included in the closing costs. And in the back end, your staff uploads the form afterwards, and that's it, right? There's no need to wait for CalCap to approve your loan before closing, and your team underwrites and closes the loan based on your underwriting criteria. I want to share sort of some examples to give a clarity of what these programs really help to do. So one example is Joseph. He's the owner of Paramount Health Services. And back in November of 2022, he received a $10,000 loan from us. Joseph has been in the healthcare industry with his wife now for more than 20 years. They have a mission to provide most comprehensive healthcare services for homebound patients, including the gamut of services you can imagine patients in home can need. He and his wife reached out to us, to AOF, for funding to help him hire more staff. Their business has been growing and they're excited to be able to reach more patients by hiring qualified skilled nurses. We gave them $10,000. Nobody would give them $10,000, right? Without the CalCap program, this loan would have never been possible. Another example is Nick and Ela. They're the founders of Bouquet. Bouquets, they source, roast, and procure coffee, tea, and herbs, and they run 2 coffee cafe locations. And he found us through one of our partners, a fintech that we partnered with called Lending Club. And he called us. He took this loan back in 2020. It was $35,000 for working capital. And when he called us, to pay it back and kind of catch up, he said that when his business started out, it was impossible to get money to grow from a bank because they wanted him to have history and collateral and all sorts of things that he didn't have. And we gave them this loan. We're willing to give him a loan, and he's been able now to thrive and succeed. Again, CalCap enabled that. So very, very important programs. The second program is the IBank, the state guarantee program. And, most of the lending we've done since the mid-2000s obviously has been with CalCap. But starting in 2020, we worked with the IBank state guarantee program. And you all may have heard about this, but one of the most successful small business relief efforts in California during COVID was through the creation of a public-private partnership using CDFIs to distribute loans known as the California Rebuilding Fund, CARF. And CARF was really 100% enabled by IBank through their state guarantee program. And what it did, it brought together community groups, lenders, corporations, and philanthropists to provide low interest loans up to $100,000 and free business support to businesses across these 2 states. With the help of the 2 FDCs, as you heard earlier, NorCal being one, Cal Southern being the other, our organization alone was able to deploy close to $50 million to almost 900 small business owners. And so this fund really helped transform the lending landscape for under-resourced small businesses in California, particularly during COVID, which was so hard for so many small businesses, because it really brought together this government funding backstop from IBank, which was a loan loss reserve. And that helped to unlock and enable lower cost private capital from banks and corporations. And then obviously CDFIs were able to operate effectively to be able to reach more underinvested markets and entrepreneurs and deliver real capital at scale. And one example that I met throughout the process is the woman, her name is Uli Nasibova, and she's the owner of Uli's Gelato in Los Angeles. She received a California Rebuilding Fund loan through AOF, and she used the loan to invest in a business, to remodel, and to pivot her business to e-commerce. And she said, I would highly recommend this program. It should be in place forever for any small business owner who's looking to build back from the pandemic and grow. This is another great example of the success that can happen when programs like this are enabled by government sector capital, where you can bring partners together and you can really achieve enormous amount of help. I heard Scott talking about different types of businesses earlier, but when you look at CARF, more than half of the loans went to people that have low to moderate incomes, and more than a third identified as women. Over a third identify as entrepreneurs of color, and more than 80% were either socially and economic disadvantaged individuals or very small businesses. And of course, you know, the 80% loan guarantee was tremendous in enabling that kind of capital. So, you know, we have a lot of success stories like many other CDFIs that have taken advantage and lenders of these programs. You know, the Joseph, the Nixon, the Elas, the Ulis, there's thousands of them, right? But with these California, you know, state programs, we can really create economic opportunity and bridge gender and racial wealth gaps in our communities across the state. So for lenders, I can only say that there's a lot of opportunity for portfolio diversity and growth here, especially with the new federal funding coming from SSBCI. And with a loan loss reserve and guarantee provisions, they really help tremendously to offset the risk. So we wouldn't be here, we would not be AOF and have had the impact and the scale of lending we've had without these programs. So I encourage all of you to explore both the CPCFA, CalCap, or IBank's program.
Thank you, Luz. And now we're going to hear from another lender. And we have Daniel Godfrey, who is Senior Vice President of Asset-Based Lending at, Daniel, is it Celtic or Celtic?
Celtic.
You pronounce it Celtic. Okay, great.
Yep.
You're
Get
up.
asked that a lot, but yeah, we say Celtic. So, hey, everybody, thanks for having me. Transition to the next slide, please, and I'll get right into it. Okay, so a little bit of background on Celtic Bank as a whole. So we're actually a state of Utah chartered industrial bank. That used to be known as a industrial loan corporation. So we are a nationwide small business lender with a government guaranteed lending focus. So that's primarily SBA 7A. We're fairly active in the USDA government guarantee program. Done a little bit in the BIA, which is the Bureau of Indian Affairs, and even the IBank program, but it's been a minute on that one. So just very active in the government guaranteed lending space. We have 29 employees in the state of California with 2 physical offices, one each in Newport Beach and San Jose. Although we don't have any branches, we're not a retail institution. That's part of the whole industrial bank kind of setup. So although logistically different, we really consider CalCap and other state, you know, each state has its own capital access program. We really consider those analogous to federal government guaranteed lending programs. So we really like programs that enable us to lend in a safe and sound manner to underserved or unbankable, as some lenders might call them, unbankable businesses as those programs become available. So for example, in addition to PPP, which everybody in the world did, we were fairly active in some short-lived kind of non-PPP federal COVID programs. And we've been involved in other state capital access programs. But in my opinion, none of the state capital access programs across the country are as beneficial or as user-friendly as CalCap. So just another way to think about government guaranteed lending as a whole can be for lenders another arrow in their proverbial quiver and how it, you know, impacts their CRA objectives, deposit gathering, and, you know, any number of activities that lenders are involved in. Next slide, please. So we've been active in both CalCap loan programs. So the small business loan loss reserve, although that's been fairly limited for us, I'll get into why. So going back to 2014 is I think when we first got involved with CalCap. I personally in another life have been involved in CalCap and specifically the loan loss reserve program going back nearly 20 years now. So just to, I know it's been around even a lot longer than that, but just to give everybody a, you know, idea of how long it's been around and, you know, how stable and great of a program it really is. So we've really found the collateral support program to be more transactional and more supportive of each individual loan by itself. So we are, as I mentioned, we're a nationwide lender. So we are very active in the state of California. We have presence there, but that not being our sole focus, the collateral support program has just given us more bang for our buck without the need to build, you know, the CalCap centric portfolio that you really need to build in the loan loss reserve program to get the full benefit of that credit enhancement. So our historic usage of the program has really been working capital and non-debt or non-real estate debt focused. So to use banking jargon, that's really more commercial and industrial C&I type of a focus. So this is important as we've looked at CalCap and used it over the years. We've really tried to embrace the standards as set forth in the regulation, which is improving access to capital for small businesses will spur investment, create jobs, and expand economic opportunities. Now, we tried to do that while still maintaining prudent underwriting, monitoring, and servicing standards. But simply put, we use the program to make loans that we would not otherwise make absent the credit enhancement offered by CalCap. So we really think there's a difference between unbankable businesses and bad businesses. All bad businesses are unbankable, but not all unbankable businesses are bad. So you got to find those. Our primary focus has been in revolving lines of credit, asset-based revolving lines of credit specifically, that are supported by inherently volatile collateral types, and those being accounts receivable and inventory. Some other asset classes as well, but primarily around accounts receivable and inventory type financing. As any banker on here can attest, generally, if it doesn't have an address, bankers don't like it as collateral. So some have the idea that a C&I loan is a UCC secured loan, but it's backed up by a lien on the business owner's home that's free and clear. We just don't see those types of opportunities. That's not the market we play in. And so we've really tried to use the CalCap program to support these types of credit requests. The other thing we like about the revolving credit program and use of CalCap is that there's no recapture depending on how you structure the loan. So if you structure an annual reviewable line of credit, which is kind of how we think revolving credits should be structured anyway, the borrower can pay an annual fee and the lender can maintain the collateral support, and there's no recapture associated with that. Whereas in an amortizing loan, there is a periodic recapture upon each anniversary of the loan. So in other words, the collateral support or credit enhancement is declining, but on those term loans, but it should be declining as the loan is amortizing. But in a revolver, you get the benefit of kind of maintaining that cash collateral support throughout the life of the loan. On a secondary basis, we use it for revolving or other credit opportunities where the business is exhibiting one or more credit weaknesses. That can be any number of things. Length of time in business, can be leverage, volatile earnings, even losses, seasonal or high inventory needs, or any number of things you can think of that makes a deal unbankable. We generally do not use CalCap for true startups. That I would say a true startup being a pre-revenue kind of company. We generally want a company to be at least established to the point that they're generating revenue, and to our usage have receivables, inventory, or have something there associated with their revenue generating activity. A couple other things that we've done recently, or actually in the past as well, and other speakers have touched on these things. For one reason or another, they're ineligible for SBA. That can be, it's been touched on foreign ownership, for example. So we've done deals with foreign investors. They qualify as a small business, but they're not eligible for SBA because of that. More flexible than SBA with regard to any number of things. Repayment structure, just how the lender wants to structure the loan. SBA has pretty canned standards around how loans generally have to be structured. These are actually really important uses that we've used the program for. There's a lack of an available guarantor or secondary source of repayment. Just to give you a quick couple of examples, I should have put a table on here to illustrate this, but take a situation where there's three owners, 60%, 20%, and 20%. Under an SBA loan, and this isn't to knock SBA again, but under an SBA loan, those 20% owners, no ifs, ands, or buts, have to provide a full and unlimited guarantee of the loan. In those types of situations, as anybody can attest, you're going to generally run into business owners who are resistant to providing a full guarantee because their economic interests don't align with providing a full guarantee. So in those types of instances, CalCap allows the lender the flexibility of providing limited guarantees, no guarantees, whatever the lender determines is appropriate. Another scenario where, say, you have 6 owners and each one is less than 20%. Again, in the SBA lending world, yet somebody has to sign on the dotted line. So, and that's with a full and unlimited guarantee. In that type of situation, you can imagine a business owner that owns less than 20% and asking to provide a full guarantee of a loan, that they can be pretty resistant to that. That can be challenging. And so again, the CalCap program can allow you to structure limited guarantees, no guarantees. However, the lender needs to really structure that to win the deal and structure it appropriately in their mind. So those are some, oh, and then last but not least, most recently, we've been active in the software and technology space. Those businesses are just inherently light on collateral because of the nature of their business. Also in those businesses, they tend to exhibit some of these early stage trends associated with maybe burning cash, operating losses, but we think there's a business plan, investment behind it, and really a strategy to turn it around to get to profitability and potentially exit the transaction and get our loan paid off. So those are how we've been using CalCap in the past. Next slide, please. Okay, so this comparison is not intended to advocate for any one approach over the other, as SBA and CalCap are both really great partners of ours, but rather just to give a kind of a comparison on some of the benefits of CalCap, as this is a CalCap presentation. So, and other speakers have touched on these things as well. So sorry if I'm repeating some of the information, but maybe good to reiterate some of these things. So as I mentioned on the other slide, we tend to use CalCap for non-real estate purposes, whereas the vast majority of our SBA transactions tend to fall within the real estate project purpose category. So again, we tend to use CalCap primarily for working capital and growth needs. So just kind of comparing a few different categories of things that lenders consider and that we look at when we're determining whether we should use CalCap or an SBA program. Again, CalCap, working capital, SBA, real estate. We don't use CalCap, although you can for real estate programs. We just don't tend to do that. So number one, ease of application and credit approval. CalCap is super easy, fast response, quick turnaround. SBA, this isn't a knock on them, just a federal program. It can be cumbersome even as a preferred lender. So if anybody here has been an SBA preferred lender and has gone through the exercise of entering and filling out all the digital and paper forms that you have to do even as a preferred lender, the CalCap program is super simple. As I'm out in the marketplace and talking to small business owners, talking about our financing opportunities, and maybe we give them a proposal that says we can make this loan, but it's going to be subject to receiving a credit enhancement from CalCap. People kind of pause and they say, oh, tell me about that. And maybe they've had a bad experience with a lender structuring an SBA loan, and they try and kind of think about it as the same thing. And so it gives them some pause. And I always have to say, no, honestly, it's super easy. It's super simple. We get a response maybe in 2 days at the longest. So the people over at CalCap are just great to work with. They really are. It's a one-page, super simple application. Attach it to your credit memorandum and send it over. And like I said, you usually hear from CalCap within about 2 days. The underwriting parameters are generally at the lender's discretion in a CalCap loan. So SBA and other federal loan programs, they have regulated parameters around guarantees, as I mentioned, around debt service coverage, around collateral when you have to take it and when you don't. And so a lot of these underwriting parameters are really at the lender's discretion. Because the lender does still have a significant exposure in the loan, CalCap tends to, base it on the lender's expertise and their best judgment. So it's just a lot more flexible with regard to underwriting parameters and some of these other things. Along the same lines, repayment terms. So you can have highly irregular, you can have revolving, really any repayment term. You can have a repayment term that exceeds the enrollment in CalCap, whatever you as the lender think is appropriate for that specific loan. And there's some reasons to this, and some of them are very sound, but as everybody probably knows, SBA generally has a very specific time and use of proceeds and repayment terms that are tied to the proceeds and the collateral type. So we kind of think, which is one reason we would enroll a loan in CalCap versus SBA, that generally 10 years is probably excessive. We just kind of think that's fundamentally inappropriate for working capital, because most working capital needs tend to be 90 days to 6 months. And so to provide a 10-year repayment period, or a 7-year in an SBA type of a structure, we just think that is probably too long. And a revolving instrument or something shorter makes a lot more sense within CalCap. The terms, pricing, fees, this should catch everybody's attention. These are also at the lender's discretion. There's a potential for fees, origination fees that aren't really available to a lender in an SBA or other federally guaranteed loan. Of course, the federally guaranteed loans have the opportunity of the secondary market. and that's a whole other thing, and there's benefits to that. But if you're looking at short-term working capital loans, you're not going to get an origination fee on a SBA loan, whereas you can charge one on a CalCap loan. So just a lot more flexibility, not to mention, there's a yield enhancement associated with the collateral support that you have on hand at the bank, and any number of things that are kind of non-quantifiable but are very much real and things for lenders to consider. The application and documentation, it's really up to the lender's discretion, their own standard forms. There's not a specific CalCap note or CalCap guarantee like there is in the SBA world. So SBA and other federal programs tend to have very mandated forms, statements, applications. It's all kind of like these other things at the lender's discretion. This is one of my favorite aspects of CalCap, actually. Default and liquidation. Although nobody ever wants to talk about it, and we hope we don't get there. The default and liquidation process in CalCap, and we haven't had too many. We think we've been good stewards of CalCap's resources, and we've had a high credit performance. It happens, and the liquidation process is super flexible. CalCap really leaves it up to the lender's judgment and expertise. Sometimes in a CalCap loan, you have to disperse a little bit of money to go collect the rest of your money. So that kind of judgment in an SBA loan would be scrutinized pretty heavily, for example. And so you have to get, you have to pass and get permission on things like liquidations and wrap-ups and a liquidation plan. And you don't have to go through that process with CalCap. So it's just a lot more flexible at the lender's discretion. It's kind of like CalCap trusts you based on your own expertise to do what you need to do. And I think our credit history within CalCap shows that we think we know what we're doing. So credit enhancement, this is also interesting. I should also put a table on this. Everyone's familiar with how an SBA guarantee works. It's a percentage of the deficiency. CalCap, depending on size, whether the loan is in a severely affected community, whether it's a manufacturing or green business, can range from 30% to 50%. So I say the credit enhancement in CalCap is an absolute dollar amount. So what do I mean by that? Well, in a SBA loan, you make $1 million SBA loan, you get 75% of the deficiency, whatever it is. Within CalCap, if you make $1 million loan and you have, based on all those other categories, you end up with a 50% cash collateral, $500,000. Well, you can end up with 100% coverage of that loan based on how the loan pays down, or if it's a revolving loan, how the loan has revolved, and then what you might liquidate with your other collateral. And if you get that $1 million loan paid down to $500,000 and you had a $500,000 credit enhancement or collateral support, you have 100% guarantee now. So it might start as something less than 100, or it does start as something less than 100, but you might end up with a guarantee or credit enhancement that's actually more attractive than a 75% deficiency guarantee in the SBA world. So that's an interesting component that we've liked about CalCap as well. And I think that's all I have for now. So I appreciate everybody's attention and CalCap having me on, and appreciate your support.
Thank you, Daniel. So we have two more lenders we're going to hear from, and then we're getting close to being able to open it up. We did have some questions in the Q&A. Again, for anybody who joined us late, all the materials will be sent to you along with a copy of the recording of this webinar after the webinar. So now we'd like to go to Andrew Neer at Innovative Lease Services. And Andrew is CEO. Andrew.
CEO and janitor, actually, technically. Yeah, so we are a small business focused independent lessor. We focus primarily in, equipment financing and working capital. We onboarded with the programs in, I think it was the beginning of 21, and we funded our first transaction in February of 21 for a kombucha manufacturer, in Los Angeles. Hey, Megan, can you skip me for a second?
Yes. Karen, you want to go on to the next person?
Sure. Let's go ahead and move on to Carlo Serafini from Bridge Bank. And Carlo's Senior Director of Corporate Banking Manager. So Carlo.
Well, thank you. I just want to say thank you to Fiona Ma, Scott Wu, and Sanford Livingston for including me in today's presentation. I manage the San Francisco corporate banking team for Bridge Bank. Bridge Bank, a division of Western Alliance, founded in 2001 in Silicon Valley. Bridge Bank offers a full spectrum of tailored business banking solutions throughout the Bay Area and has specialized expertise in C&I, life sciences, technology, and innovation companies at early stage of their life cycle. Wanted to just touch on some best practices and as well as how to utilize both programs, both the loan guarantee and the collateral support program, which we had been successful in California for expansion purposes, working capital, equipment, and TIs. I think we have a good understanding of the programs with everybody that has presented today. So I think I'm just going to jump right into what we're doing, and maybe this might help your guys' offices. First, I think it's important to understand the guidelines of fee structure for both programs. I could recommend reviewing the lender and training information and work with your local FTC or your Treasury program officer. As I mentioned, we're located in San Francisco, so we work with Sanford Livingston and also Byron Phillips from NorCal, and we also work with Lauren Dominguez, who's our Treasury program officer. We couldn't do what we do without them. We discuss our opportunities early and we strategize together. My team of relationship managers and portfolio managers understand the guidelines just as good as if it was our credit policy. And I think that's really what differentiates us in the market. But I would recommend, really getting up to speed and understanding the details there. We do look at each deal independently. We go through our normal underwriting and due diligence process, and we need to have a clear primary source of repayment, cash flow for debt service, and then we evaluate our secondary source of repayment to determine our collateral coverage. Based on our proposed credit facility and structure, we would recommend one of the following or both programs. One example how we utilized two programs was that there was a loan request for $11.2 million. We had a strong to moderate primary source of repayment, but a weak secondary source of repayment since we were financing TIs. The org structure included 3 different subsidiaries that rolled up to one parent company. We were able to find a solution to finance the project by establishing 3 separate credit facilities for 3 different purposes. NorCal supported us with the loan guarantee program for the larger term loan, and we used a longer amortization to 7 years. And the 2 other term loans had a shorter amortization of 4 years, which we used the CalCap collateral support. We were able to maximize the support since this was a green project, which meant that we can go up to $2.5 million with the CalCap collateral support. The job creation, talking about job creation, the direct job creation is forecasted about 235 and indirect at 265. So I think that's obviously what we're trying to achieve here, right? As far as utilizing both programs, it's really important to, again, have a discussion both with your FTC and your Treasury program officer, and just talk through different scenarios. And then as well with the client, if there's 2 different revenue streams and different purposes, you might be able to utilize both programs. Other than that, I just want to say thank you to everybody. It's really been a pleasure working with the people that I mentioned. And, we have a pretty significant pipeline for this year, and we look forward to doing more business.
Thank you, Carlo. And just want to check and see if we have Andrew back.
Think we are going to move on to our wrap up.
Okay, sounds good. So we're going to toss it back to Sanford from NorCal FDC just to talk a little bit about the impact of increasing access to capital. So Sanford, do we have you?
Yes, you do. Can you hear me?
Yep.
Well, very quickly, I mean, this program is amazing. And, I've been in other states, and I just want you to know from an overall standpoint, I look at this as just an amazing tool to be able to help the economic engine of California. I think as you've learned in this call, there was 1.2 billion for the whole SSBCI 1.0, and then 10 billion for the second SSBCI, which we're involved in right now. Well, I'll just let you know, California does such a great job through the Treasurer's office, as well as with the Infrastructure Bank of California, that the funds from the first SSBCI are still being used to leverage and help many of the small businesses that we were just discussing. And we are looking to do even having a greater reach with the second SSBCI. I remember I've been over at NorCal for a few years and watched how we, really utilized the program via the lenders and the CDFIs to reach these incredible projects that we're having, even through the climate tech finance that we have now, and helping, businesses that have an impact with the carbon footprint here in California. We're looking at, our switch to many of the goals of the state, which is to have, electric vehicles by a certain date. I think it's 2035, and the infrastructure being built. These programs and these tools that we're using are having an incredible impact as we look at, the progression of EV charging stations and cleaner water and clearer air, that, we're using this program to attract that. And so when we look at the folks that are on this call, that are looking to figure out how to engage, the IBank and the state has made it very, very simple to do. Again, the certification, contact your local FDC. Myself, JC, Juan Carlos are available. As you heard Carlo mention, we meet with our lenders constantly to find out what their goals are, and connect and figure out, can we have shared goals and visions on how to help these businesses get the capital that they deserve with a protection connection through the guarantee program. So we've had a great time. There's when you get into it, you'll learn that there's been the California Rebuild Program. There's been the Disaster Relief Program. There have been tons of usage of these programs with the state guarantee and the Treasurer's CalCap program. So I really, really hope that everyone on the call, dig through Google, talk to each other, make phone calls. We all know each other. This is a great ecosystem. Find a way that we can really use the program. And as the executives, Scott and Fiona and Megan have said, we've got to use these dollars so we can keep them in California for future use. And I'm looking forward to hearing the phone ring and emails come with you guys suggesting how we can actually move forward to helping these entrepreneurs. Thank you, Ken.
Thank you, Sanford. So we're going to have a few closing thoughts from Sheila Tobias Daniel again, and then we will go ahead. It looks as though most of the questions that were asked were responded to in the chat, but I do want to make sure that the folks who asked those questions felt that they got an adequate response. So we'll start with those just right after Sheila.
Thank you, Karen. So first of all, I just want to thank the teams at IBank and CalCap, CPCFA for the wonderful job they did in pulling this all together and standing up this webinar today. Thank you. Fantastic job, team. Today's webinar, it covered our programs offered between IBank and CalCap. We talked about the CalCap for small business. We talked about CalCap collateral support, IBank small business loan guarantee program, and I even heard Scott talk about their new venture capital program. We hope that you've learned about these programs today and learn some of the similarities and differences between the programs. And I just so enjoyed hearing the examples of how lenders are using these programs to support their portfolios and to help serve California small businesses. It made me feel really good about the work that we do here. You know, I'm here to just issue a call to action. I encourage you to use these programs to expand your portfolios and to reach out to a peer in the industry to make sure they learn about these programs so that all of California can advance to the second tranche. You know, I referred to our partnership with IBank earlier as we are Team California. I hope you've learned today that you are an important part of that team. Together with our participating financial institutions, we're all Team California. I want to take a minute to highlight a couple of key features of that CalCap for Small Business program that we described earlier. I want to make sure you all leave with the understanding that that CalCap for Small Business program will match both the PFI, participating financial institution, and borrower contributions. So if the PFI contributes 3.5 and the borrower 3.5, we at CalCap will match that with 7%. So that's a good feature to keep in mind. And also, I don't think we mentioned that we heard back from our lenders who participated in SSBCI 1.0, where we established a recapture feature. And we heard that that wasn't so popular with our lenders. And we listened to them for that CalCap for Small Business program, and we have removed that recapture feature. So those of you already enrolled with us, you know what that's all about, and I am pleased to announce that we have removed that feature. Look, the key takeaways are that these programs all have proven track records. Scott shared with you earlier some of the history of his programs, and CalCap has been around helping financial institutions serve small businesses since 1994. You know, California is very fortunate to have such a variety of different types of capital access vehicles that are complementary and not competitive. We hope you've learned today how you as lenders can leverage these programs, expand your portfolios, and serve and support California small business. Those of you already enrolled with us, I hope you are excited to continue with our programs for this iteration of SSBCI 2.0. Those of you who are not already enrolled with us, I hope that what you heard today will help you decide to become one of our participating financial institutions and join Team California for this round of SSBCI 2.0. Just as a reminder, all of the registrants today will receive a copy of this webinar recording and fact sheets for each program and any documents that we shared on the call. So with that, I'm going to turn it back over to Karen to see if she can help us gather any additional questions that we may have received in the chat. Thank you again for joining us.
Thank you, Sheila. So I just wanted to start quickly with, I don't know if it's Andrea or Andrea Donnelly, who had asked if there's a documented set of SOPs for origination and servicing for any of the programs that lenders can obtain. And I know there were a couple of responses to that, but sorry if it's Andrea or Andrea, did you get an answer that works for you? If you're still on the call, you might be on mute. Okay, she may have dropped off.
Hello, can you hear me?
Yes, I can hear you now.
Okay, all right, great. I did get some responses, but I did not get links to those documents. I would love to get some links to those documents.
Okay.
We could send them in the follow-up
We
That
will
would be
go
great.
ahead and,
so
yeah,
that everybody can get them.
great. Thank you. And let's see, a lot of comments on see how great San Diego is. So I'm just still scrolling here. Give me just 1 second. I know that the financial development corporations have offered to work with the lenders around the state, so we will make sure that we do include links to the list of financial development corporations around the state. And that way you can contact them to kind of have some more in-depth conversations about these programs and how they work and how they may be able to help you given your specific circumstances and goals for your lending institution. And is there anybody else who had some questions that you can, feel free to just go ahead and put it into the chat.
I see a question from Sharon Evans. Can you cover the increased in guarantee or collateral that may be applied to loans that are in local disaster areas? I am not the program manager experts, but I believe the current coverages were part of the application to the US Treasury for each program. So we will be sticking to the parameters that exist within the programs, but the CalCap programs do have a structure called severely affected community that can, if the location of the business is such as a disaster area, the lender can apply for that increased contribution.
And Megan, do you want to speak to although not specific to SSBCI, the disaster loan guarantees?
Sure. So at IBank in the Small Business Finance Center, we also have a disaster relief loan guarantee program where as long as a business is affected by a declared disaster, either an economic injury or a physical loss, they would be eligible for up to 95% of a loan guarantee. So we do help those that have been affected by disaster as well. But as Karen mentioned, that's not a part of SSBCI. SSBCI only allows us to guarantee up to 80%. So
great. And then I believe there's another question in here, Allison, for around CalCap. Let's see, for existing CalCap institutions, is there a link for a tier level reserve requirements and timelines that these reserves may fluctuate? From
we are checking to see if that is something that we can answer off the top or if we'll need to email. Thank you.
Okay. And then a question to Megan about how much longer the disaster loan guarantee will be available.
we don't have an expiration on it. That was kind of the beauty of our program versus some of the federal programs. When a disaster occurs, they have kind of a cutoff date as to where you can apply by, but we don't actually have a sunset date on the disasters.
Just going to give one more minute here to see if anybody else would like to add a question to the chat. From Small Business Majority, Bianca, how will folks be notified of program updates? Sure, who would like to take that? Megan, do you have? And sorry, Bianca, I don't know if you want to take yourself off mute. Just in terms of changes to the parameters for the programs or how they're performing, what type of program updates?
Thanks, Karen. I appreciate it. So I'm aware that there are, I guess 3 different programs we're talking about today, but then also the venture capital program. And curious how stakeholders will be updated as to how the programs are doing. So that we can either work to secure additional participation in the program, and how those updates will be communicated to community-based organizations who also raise awareness about the availability of these programs.
So for the Small Business Finance Center, anything relating to the program directly that the lenders need to know about is done through the Financial Development Corporation. So we would send an update to the FDCs and they would send it out to their lender lists to update them on any policy changes to the program. As far as just overall, we have listservs with interested parties in each of our programs, both venture capital and the loan guarantee program, and any program-wide information would be shared through those.
And with CalCap, we do host lender roundtables from time to time, and we get the information out to our list of lenders, our lender network, and we host lender roundtables. That's how we learn things like that our lenders weren't too big on the recapture program. So in those lender roundtables, we do provide our lender network with updates and also listen to them and get their feedback. So those of you who participate with us, look to receive invitations to those lender roundtables, because that's how we communicate with our lenders.
Thanks, Sheila.
And I'll just add, there are reporting requirements to the US Treasury that all the programs will be using. And I believe we will all have links to those on our web pages, both to the actual reports and then to any changes that whenever we have to make a change to the program regulations, that is also sent out to our listserv. It is on our web page, that type of thing. So if you haven't signed up for, go to IBank and CPCFA's pages to sign up to be on listservs. Thank you.
We have another question in the collateral support program. Is the cash collateral deposited at the financial institution applying for the cash pledge?
At the time when the eligible financial institution applies to be a participating financial institution, part of this process, that process determines whether cash pledges will be deposited with a trustee financial institution or with the participating financial institution. Either way, the accounts do belong to the program.
Thank you. Will there be a state microloan RLF like the SBA microloan? And a second question, will there be a consideration for CalCap match to match a higher ratio for microloan $50,000 under?
Let's see, I can't speak to the SBA microloan, but I think the answer would be that I don't believe that's part of the US Treasury guidelines for SSBCI 2.0. Megan or anyone else will jump in to correct me. And then for CalCap to match a higher ratio, the 7% is the max allowed by US Treasury for a loan loss reserve program.
And the last question I see right now is, in support of small businesses, is there a minimum requirement to qualify for a state loan guarantee?
There actually is not a minimum. We see loans, we see a lot of microloans. There is not a minimum for our program.
Okay. I think that's it for the questions at this point. And we're just seeing some more responses to those. So again, thank you all for joining us. We will again send out all the materials and the recording to everyone who registered for the webinar. And we hope you found this useful, and we look forward to meeting with you in the future as we offer more outreach around these SSBCI programs, and we look forward to reporting out on our successes that, again, we could not do without those of you on the call using the program. So look for more information to come, and thank you all for tuning in today. Bye-bye.
Thank you. Bye.
Thanks.